Hello, my name is Dan Page, and I'm the president of Boulder Equity Partners. We are commercial real estate lenders funding nationwide, and I'm here today to talk to you about understanding which commercial real estate loan product might be the best fit for you, because everybody has different circumstances that'll affect the decision as far as which ones might make the most sense for you. So first, some quick background. I've been in the commercial real estate finance industry for over 30 years. I've funded well over $1 billion of transactions. I'm the go-to guy for thousands of commercial loan brokers nationwide, and I review a lot of loan submissions on a daily basis, sometimes up to 15 or 20 a day. So I see a lot of different loan programs and loan requests and give you a sense of what might be the best fit for you. So there are a lot of different commercial loan programs out there in the market. The question is, which one is the best for you? And it's all about finding what the best fit is for you based on your unique circumstances. So borrowers often shop for loans just based on interest rates. And there's absolutely nothing wrong with that. We all want the lowest interest rate. Of course we do. But sometimes there are unique factors that the lowest interest rate may not necessarily be the best fit for you. Boulder Equity Partners definitely has low interest rate programs, but we also have other programs that sometimes might be a better fit based on your particular scenario. So, for example, low interest loans quite often carry a very long prepayment penalty, or what's called yield maintenance. So if you're into that loan, you might not be able to get out of it for quite some time unless you pay a large penalty. And that's great for some situations, but not for all. So this can make sometimes low interest options expensive for some borrowers if they only want to be in the loan for a year or two versus 5, 10, or even longer periods of time. So when I meet with a borrower, the first thing that I do is I ask a whole lot of questions. I try to focus on their goals, what they're really interested in, and what they're trying to achieve with the loan they're requesting. For example, what does the borrower want to do with the property? That can change from time to time, and what their goals are today might be different than what they are a year from now or 2 years from now. So I try to dig a little bit and understand those different parameters and needs. For example, does the borrower, or do you as the borrower, plan on holding the property for just a short period of time? Do you have a deadline that you need to have that loan consummated and funded, either it's a purchase or a refinance? Do you need to do rehab or capital expenditures on the property? Is the property not fully stabilized or occupied, so you need to lease it up? Or are the rents under market and you need to raise those rents as leases expire? All those things are factors into which program might be a best fit for you. So with a longer term program, it's a long term. By long term, I mean anywhere between 5 and 40 years. It can be a whole range. That's considered a long term loan. So typically these long term loans, again, lower interest rate, but they're really for stabilized properties. So you have high occupancy, solid income, and a high what's called debt to service ratio. We can talk about that in more detail at another time. So these long-term loans have much more stringent underwriting requirements than short-term loans do. Again, that higher debt service coverage ratio, that's what the DSCR stands for. And again, we might have a longer prepayment penalty ranging from the absolute shortest of 2 years all the way up to, it could be 10, 15, 25 years, all depending on the term of the loan. So these strong long-term borrowers looking for long-term loans are going to be best if the borrower and the borrower's property has really strong qualifications, solid income, a property is producing regular predictable income, and that borrower plans to hold the property for a longer period of time, so that long prepayment penalty isn't an issue. Contrast that with bridge loans. Higher interest loans, there might be higher interest on the front end, but those payments are interest only, and sometimes a higher interest bridge loan with the interest only a payment, that payment might not necessarily be any more expensive than those lower interest perm loans, all depending on the unique scenario. So again, it's a shorter term, shorter prepayment penalty. It's typically much easier to fund, lower underwriting, quicker to close. And once that property is stabilized, then you can go back and migrate that into a longer term perm loan with a lower interest rate. So a bridge loan is really ideal when the borrower is looking to rehab that property, or they might be selling this property on a short-term basis. Maybe it's underperforming right now. They want to get it leased up, get rents raised, get the property rehabbed, and then sell it or refinance into a longer perm loan. And also, if you're just looking for that quick close, I mean, I can close sometimes these bridge loans in as little as 2 to 3 weeks, whereas the long-term perm loan can take as long as 3 months. So big difference there. The bridge loans are also ideal when you're paying off a construction loan and the property's not quite stabilized yet, and it's going to take 6 to 12 months to get stabilized and have that predictable income stream so that you can qualify for a long-term perm loan. Another scenario is when the current rents might be under market right now because the current owner or the previous owner hadn't raised rents for quite some time. And then it might be another great example for a bridge loan. We also offer another option, what we call a short money loan. They're lower interest rates like a traditional bridge loan, but it doesn't have that long prepayment penalty. The prepay penalty might be only 2 years as opposed to 5, 10, or 20 years on longer term perm loans. And it's easier underwriting and qualification requirements. So that's another thing to think about. And one more thing to add here before we end is we just recently launched what I call a Lifeco product that is even longer terms and much lower interest rates, but might be a good fit for you as well. So I hope that's helpful. I look forward to talking with you. Again, we're a nationwide lender for all commercial real estate loans. We offer both low interest and long-term products and quick close products like our bridge loan. So feel free to give me a call at 303-938-8280. You can also shoot me an email at dan@boulderequitypartners.com. Until I speak to you, have a wonderful day, and I look forward to working together. Thank you.